First, let me thank the presenters for the organizers for inviting me to present this paper, and let me also thank a contribution by Aditya Narain, who was very instrumental in putting together the paper. Of course, there were many other colleagues both inside and outside the IMF that have provided comments and shaped the paper, pun intended. Needless to say, the crisis has caused us to be very introspective about the functions of the financial system and its ability to intermediate between savers and borrowers. While there have been a number of reasons for the crisis, one that has received the most attention has been the failings of regulation and supervision, and hence the attention to financial reforms. Clearly, this is not being done in a vacuum, and the ongoing interaction between the financial system and the private sector will continue to shape the contours of the future financial system. This paper examines this interaction by noting several new elements in the thinking of supervision and regulation. Specifically, these are, first, an increased acknowledgement that assuring the safety and soundness of individual institutions is simply not enough. Systemic risk can develop from the interactions of institutions and their interactions with markets. Second, an increased awareness of the detrimental effects of leverage. While many financial crises are related to excessive leverage, modern financial markets can make measuring and observing leverage difficult, calling for renewed work in this area. Third, an increased attention to the need for globally consistent regulation and crisis resolution frameworks. The spread of the crisis across the globe and its pervasiveness have focused attention on the necessity of ensuring a holistic approach. The path to a sounder, more stable financial system, however, does not mean that we load up on regulation. Doing so may indeed make our financial system safer, but at what cost? The cost will be less innovation, less flexibility, and very possibly less economic growth. However, if we get it right, with sensible and better regulation, we may be able to encourage participation in the financial system without lowering the growth path by very much. The IMF is in a good position to attain this goal, and I'll highlight several ways in which we can be of assistance at the end of our talk. To set the stage for how financial reforms are taking shape, it's worth reviewing a few of the failings that are driving the reforms. The reasons were many, but a few stick out. Within the private sector, there were shortcomings in risk management systems, excessive use of short-term wholesale funding of longer maturity illiquid assets, and compensation structures rewarded short-term returns without considering their associated risks. In the supervisory and regulatory arena, there was too much trust in market discipline, and a notion that the private sector knows best set in. Self-regulation was thought to be sufficient in many areas. There was lax implementation and enforcement of existing regulations, even where such regulations were well designed. Most supervisors worked in an environment that stressed the safety and soundness of individual institutions, and too little attention was given to their interconnected exposures and particularly systemic liquidity vulnerabilities. And when the crisis struck, resolution regimes were unable to deal with non-banks and the cross-border spread of difficulties. Uncertainty about who was exposed to whom aggravated the situation. Macroeconomic policy was not entirely without blame. While economists have varying views, relatively loose monetary policy was at least a contributing factor. And fiscal balances had not been built up during the good times to an extent that would allow for the massive fiscal resources that were subsequently needed. So what financial reforms are now in train to deal with these particular issues? There are two basic approaches being taken in the aftermath of the crisis. First are ex-ante preventive measures to control the buildup of financial risks. These comprise both better micro-prudential tools for individual institutions and the development of a set of macro-prudential measures to better cope with the systemic component. Second are an improvement in ex-post resolution regimes to help ensure that when disaster does strike, it can be dealt with in a way that prevents knock-on effects and maintains a smooth intermediation process. Of the microprudential measures, the Basel Committee has already implemented some further refinements to Basel II capital requirements to close loopholes, and has put forth guidelines on funding liquidity and on compensation schemes. More recently, it has proposed definitions of better loss-absorbing capital and further refinements to capital requirements and liquidity risk management. The development and implementation of macroprudential measures is still in early stages, with attention to various forms of procyclicality, especially those related to capital requirements and provisioning rules. On the horizon, being discussed in a number of countries, is the implementation of some sort of capital charge or tax applied to systemically important institutions based on their contribution to systemic risk. On these issues, the Basel Committee has asked for further guidance in order to proceed. However, moves to assure non-banks are under a similar regime have not yet been forthcoming. Another approach is to limit the chances of another crisis by making financial institutions themselves less risky, by perhaps imposing limitations on risky activities or business lines, say by removing banks' proprietary trading desks, establishing concentration rules or position limits. It is perhaps worth underscoring that understanding what causes systemic risk and then finding practical ways of inhibiting such risks is the first best solution. The crisis has already taught us that size, per se, or the individual riskiness of an institution, conventionally measured, is not necessarily the best guide for their systemic importance. As regard reforms to strengthen ex post resolution techniques, quite a lot of effort is going into resolution procedures for banks and especially for non-banks. This is particularly hard work because many of these mechanisms are ingrained in laws and they're not easy to change. And the problems are even more difficult when you get to cross-border resolution schemes. Nonetheless, work is in train. There are also suggestions to make financial institutions plan for their own financial difficulties. The idea of a living will and the use of contingent capital are such proposals. These latter two proposals may have the added advantage of encouraging better ex ante behavior. There are also reforms underway to markets and products. For instance, regulators have asked derivative dealers to move their OTC derivative contracts, especially credit default swaps, to central counterparties to alleviate counterparty credit risk. Improving information and transparency by collecting at a centralized source the outstanding trades of various counterparties, a so-called trade repository, is also being promoted. Reforms to actual products are difficult since the financial market produces its own products. But many investors, including the so-called sophisticated ones, are demanding more information about what they are purchasing and how it's priced and modeled. This is most evident in the securitization markets, where the incentives for providing timely and complete information were poor during the crisis. Having set up this background, how will the financial system evolve? The paper sets forth a number of questions and attempts some answers. Much depends on whether the above reform agenda moves forward. I will take this set of questions raised in the paper and provide some quick overview about our thinking. What will be the role of banks and non-banks? With more oversight and regulation clamping down on banks, they will be less leveraged and unable to make the returns that they have made in the past. Their non-bank competitors will be unlikely to face the same stringent regulation, with the exception of a few that might be deemed systemically important. Non-banks will thus take much of the more risky business lines that banks have had to give up and will likely grow faster. On the demand side, there will be interest from investors who feel the need to improve their retirement prospects given the hit to their savings in the last 2 years, forcing them to invest in riskier instruments to make it up. There are still some remaining issues that could alter this outcome. It will depend importantly about how we decide where to place the financial safety net and what that safety net covers. The more we limit banks to being traditional banks and keep the safety net covering only retail deposits, the smaller will be the role of banks, and the more we will need to watch the perimeter to see where institutions are building up risks and how to handle them if risks materialize. On the other hand, if we don't adequately reinstate some credibility for limiting the safety net, then banks will retain their current larger role. In fact, some institutions may desire to become too important to fail if they see little resolve to limit the usage of the safety net. Clearly, credibility needs to be rebuilt. To do so, the reforms need to be transparent about who and what is covered in various situations. Hard to break rules about when governments and central banks are permitted to step in would also help. In the end, however, as with any provision of insurance, the existence of a safety net will be associated with some degree of moral hazard. Will the financial system be smaller? This one is difficult. Having argued that the banking system will shrink and the non-banking system will likely grow, the size of the whole depends on how much shrinkage and how much growth. Banking systems will shrink in the short run due to deleveraging, and based on the likely reaction of households and firms, the non-banking sector will likely grow. It is certainly plausible that given the massive buildup in the size of financial systems globally prior to the crisis, that the whole shrinks. Hence, I would argue that there are other productive uses of capital besides the financial system where innovations were uneconomic that will find their way into the real economy, and the upper right-hand figure is the likely outcome. Will global financial integration continue or reverse? Though not guaranteed, the forces propelling financial globalization are quite strong. Technological advances in communications, a desire to transfer risks, global institutions following their corporate clients as trade channels intensify, and so on. Still, emerging economies have not been comforted by the events in the advanced countries, and many are questioning whether some of the innovations, such as securitization, are worth emulating. Moreover, those emerging market countries dependent on banks domiciled in advanced countries have found the last 2 years rather trying, and we have yet to see a complete bounce back in cross-border bank flows from the depths of the crisis. In order to ensure that the benefits of financial globalization are realized and financial protectionism is not given a foothold, countries will need to look toward globally accepted guidelines, a set of tried and true regulatory approaches and supervisory practices. Improved infrastructure and information can help. Agreement on new reforms could also solidify the gains that have already been made, though admittedly, gaining broad consensus on some of these issues is going to be difficult. What kinds of banks will we have, bigger or smaller? The answer is probably a mix, perhaps even a bipolar result. Some banks will shrink on purpose, spinning off riskier business lines and going back to what they do best, collecting deposits and making loans. Some banks, such as well-managed cooperatives and savings banks that have come through relatively undamaged, will continue to supply credit to small and medium-sized enterprises and service households. However, global banks are here to stay, and some banks are even larger and even more complex than they were before. These banks will probably just absorb the new higher costs of doing business, make less money, and still be active in global markets, servicing the top echelon of global corporates. A critical question going forward will be how are these large banks going to fund themselves, especially in light of reforms that are going to make their usual means of doing so far more expensive. What types of markets will thrive? Simpler, more transparent? Demands for more information surrounding various instruments, such as their underlying risks, their pricing models, and trading activity are now becoming commonplace. Standardization is also picking up, as it makes risks more transparent and can allow netting of exposures to lower overall risk. Active trading on exchanges is also then enabled. There is a focus on removing risks through improved infrastructure of various types, including central counterparties and clearing and settlement procedures that will reduce operational and legal risk. Will certain types of instruments be encouraged or discouraged? Already, investors are moving away from risky, complex instruments. Some of this may be mandated as regulators take a closer look at so-called suitability criteria and the economic purpose of products. In fact, here in Korea, there is a bill about to be passed to force banks to seek approval before selling new types of OTC derivatives. Any new credit derivative product would need to be reviewed by the newly established Korean Financial Investment Association, regardless of the sophistication of the counterparty. While each country will be inclined to develop their own set of guidelines or rules, and let me stress that such restrictions may well be warranted, there is a risk that by doing so, an uneven playing field gets established, and new products move to less regulated jurisdictions. A globally consistent set of guidelines would certainly be helpful here. So, overall, how will the private sector adapt to the new set of regulations? Reluctantly is probably a realistic answer. Already the lobbying efforts are strong, and a number of new efforts to self-regulate through various best practice codes are underway. While these are good efforts, they are unlikely to be sufficient to address systemic risks. The private sector recognizes that there is a collective action problem preventing it from addressing systemic risks, but they are making headway in some areas. For instance, better information on exposures will help, and the private sector is supplying more of it to trade repositories. But in some cases, the move to reduce systemic risk by the private sector may exacerbate it instead. For instance, having too many privately owned counterparty credit rates competing for business. So what can the fund do in its capacity? A number of items come to mind, and I've listed them here. Of the most important at the moment is the need to develop practical, workable regulatory reforms and pursue a more macro-prudential approach. We are well placed in this regard as we observe many of our members' financial systems through our ongoing financial sector assessment programs and our review of standards and codes, or ROSCs. We have invested heavily in tools to measure systemic risks and detect macro-financial linkages. We can also serve as a place to negotiate global standards for all of our members, not unlike our recent experience in the area of sovereign wealth funds. Having started with some ideas about what the contours of the future financial system will look like, I have just a few final thoughts. First, it is clear we need to improve our financial system, making it more stable, less subject to shocks, and more resilient to them in order to forestall their transmission to the real economy. Second, to do this, we must act judiciously so as not to put in place too many restrictions and lose the benefits of innovation and risk transfer that can allow for efficient intermediation. Third, we should recognize that this will not be easy, and the authorities responsible will need to be steadfast in their resolve to move forward expeditiously. At the same time, they must be cognizant of areas where we are still searching for answers about the potential effectiveness of reforms. The term "do no harm" comes to mind. The private sector does not like to be constrained, and it will be an arduous process. Still, the momentum to put in place reforms to avert the kinds of difficulties we have just experienced cannot be allowed to languish. The contours that I have just outlined will look much different if progress is not made. Thank you.